Bismillahirrahmanirrahim. Subject is Advanced Corporate Finance and topic is Capital Structure Theories. Learning agenda for today lecture is Capital Structure Definition, and we will discuss theories of capital structure. We will discuss just two approaches. One is called net income approach and other is called traditional approach. Capital structure is defined as a combination of debt and equity. So firm need financing in order to finance assets and other activity. They need financing. It can be from general public, JP, or from any bank. So those that bear fixed cost is called debt, while those who give the shareholder voting right, etc., are called equity or shareholder. So capital structure is basically a combination of three things: debt, fixed income securities, preferred stock, and common shares. These are the combinations which make capital structure of any organizations. A common share are issues to general public, and these have a voting right and claim on the residual of the company. Preferred shareholder don't have a voting right. They don't have a voting right. They will be preferred. Preference will be given in paying dividend to them. They don't have any residual rights on the asset of the company. The right on the asset of the company is just limited to face value of the preference shares. Debt is basically it bear a fixed cost like 10% on the value of the security, maybe 5% of the on the value of security that have been extended as a credit to the organization of the companies. So capital structure is combination of these three things. We will discuss later on these in detail, not in this lecture but in a coming lecture. Moving further, assumptions. In order to understand these theory, certain assumption must be keep in mind. First assumption is perfect capital market. What is perfect capital market? That no transaction cost is there in the financial market of the shares or in the market of the financial in any other financial market, but it is not practicable because there are brokerage charges, brokerage commission, there is taxes, there is issuance cost, flotation cost, etc. These are all costs that any organization or individual have to bear. Negligible flotation cost, it is not negligible because when share are issues, there are costs such as underwriting commissions, such as issuance of printing of prospectus and many other costs that are bear by the company. No investor can affect the market. It is a possibility because any efficient market are not beat by a single investors because information are readily available. Again, there are some mature market which are beat by the investors and manipulate the shares and create a bubble and then fraud all of their shares or sale of their share and on the abnormal profit. George Soros is one of the prominent name in such cases. Informations are available freely. Yep, information are available freely, but interpretation of these information are not equally the same for all investors. Some investor may interpret the information in one way, but other investor may be informations in different. Investors are free to sell and purchase the security, obviously, but this assumption is always difficult. Sometimes lower caps is there in the capital market, and you will not buy or share that specific share of the company on which lower cap have been imposed. Similarly, there is an upper cap as well, and when upper capitalization lock is announced on any share, you can't buy this share anymore on that specific day. But these are realistic assumptions, these last two. No transaction and no taxes are not realistic. Homogeneous risk to all class of all firms. Homogeneous risk means that in cement industry all firms will face the same risk. In banking industry, the all firm will face the same risk. So if anybody want to invest in cement industry, there will be separate risk class. If anybody want to invest in chemical, then separate risk class, and in banking separate risk class. But for the whole industry, means for banking, for chemical, as far as that of cement, they will have a homogeneous risk class for these firms. Means if there is a flood will be for all companies. If there is any inflation for all companies. If there is shortages of any input, it will be for the all firms. These homogeneous risk class of all firms. Homogeneous expectation of all investors about the future return. Exactly, future return, since it is uncertain, and people or investor calculate these future return on the basis of certain assumption or on the basis of certain probability distribution. So it is not always normal. For example, if one investor expect that he can earn 50% return from the market, while others said for the same asset that many of the investors said that they will earn 10%, round about 10%. So this is for the many other investors. Let's suppose group of investor or huge investor expect 10%, while one investor expect 50%. It is not possible. These expectations should be homogeneous. Like for these one, how can this person earn 50% return from that asset in which these people are going to invest? So this returns are calculated on certain information, and these information are then their probability are calculated, and this probability distribution must be same for the all investors. For example, if anybody want to invest in OGDCL shares, they would definitely calculate their future return, but this return will be calculated on certain data. So first they will calculate the probability distribution of OGDCL return for the 1 year, or for 3 year, or for 2 year. So this probability distribution will be same for these all investors. No taxes. Obviously there is no country in the world without taxes, but this is again in assumptions for understanding this capital structure theory. 100% dividend is payout maybe somewhere in a paradise, but the company in Pakistan and all over the world do not pay 100% dividend. They keep the dividend for the growth. But these are assumptions in order to understand the capital structure theories. Net operating income approach. Net operating income approach is based on certain assumption that these are, first is by David Durant, who says that debt will be used to replace the equity. It means that if there is 100% equity before the debt of any company, let's suppose 100 rupees or $100, and the company take a debt of 50, then this 50 will be, total equity will not be 150. He assumed that that will not be 150. So this is not his assumption. He says that equity will be reduced by 50 because these 50 will be given to this shareholder. Debt will be replaced, the equity will be replaced by debt. The debt was acquired will be used to repurchase its share. Total equity will remain same, that would be 100. In capital will be 100, equity will be decreased. Debt is available with constant rate and unlimited, means if you are buying 1 rupees or $1, it will cost you, let's suppose 5%. If you go to buy $1 million, then again will be 5%. This is not practicable, but it is assumptions, because when you are going to borrow high, you will be charged for higher amount of interest rate. So debt is available at constant rate. That constant rate is basically an assumption, and you can borrow unlimited amount. No, that will be challenged in the coming approach. Firm is valued or capitalized on overall stock of capital. Basically, capitalization means you will have a rate and you will have a cash flow. So if this cash flow is forever, your value or capitalization will be equal to your cash flow divided by your required rate of return. Cash flow divided by rate. This is basically formula of fundamental financial management or basic financial management course. This approach educates that capital structure degree of leverage has no impact on overall value of the firm. Only cost of equity increases with increases in debt, as shareholder expect more return with increased risk associated with the debt. Assume or in illustration that the company, let's suppose, have 60,000 earning before interest and tax. Total capital is its first turn is 400,000. Cost of debt is 10%. Overall cost is 12%. What is the cost of equity in different combination of the debt and equity structure? So let's suppose 0%. First case, no debt at all. Shareholder equity is 400,000 rupees. EBIT is 60,000, no interest. So earning available to shareholder is 60,000. Now capitalization is, value of the firm will be this figure divided by 12%. Overall capital means EBIT EBT divided by 12% means total cost. So this divided by 0.20 is 500,000. Okay, again 2 20,000, 80,000 is interest, and 80,000 is debt. Now that is 10% cost, so it is EBIT minus this 52,000. So 52,000 will be divided by this will be divided by 12, which will be 500,000. EBIT divided by K. Again, this is we will discuss here. So cost of debt is 10%, cost of equity is 12%, and cost of EBIT is 12%. Cost of equity. Cost of equity is basically value of shares. That is this amount divided by this one, 500,000. Now value of the firm is again same, but value of the debt is this one. Value for the share is 420,000. So this amount means this is available to the shareholder. 52,000 will be divided by this value. We will get value of equity this much. Similarly, we have a debt of 200,000, so 50%. Here we will charge an interest at 10%, 20,000 available to the common shareholder, that is that amount. 500 is the value of the firm minus value of the debt 300. So this will be divided by this 300, that is 20%. Similarly, here is a debt of 320. Total value is remain the same, that is 32,000. 28,000 is your equity available. So 500, 180,000 is basically what? Value of the share. When we divided 28,000 by 180, we will get 33% of the value of equity. Why this value increases? What is theoretical background? Let me explain you. Since debt is increasing, overall value remain the same. In this, cost is always is assumed that it is remains same as in assumptions. But when debt increases, risk profile also increases of the company. Companies with high debt are risky companies, so shareholder will expect high equity return, and those who invest in this company with high debt will require high equity return. So the equity return increases as the debt increases, because the risk profile increases. When the risk is high, so the people also demand high return. But the overall overall cost of capital remains same. Now traditional approach, the net income approach is, this approach suggests debt increase value of the firm and reduce overall cost of the capital. As not that overall cost of the capital remains same in net income, here it will be reduced. It suggests that capital structure matter is a valuation of firm. Means capital structure impact the value of the firm. This is second assumptions for this traditional approach. Firm may increases its value by achieving optimal capital structure. This says that there is optimal capital structure which can be achieved by good combination of debt and equity. It says that when the company borrow additional debt, it will charge high interest rate on them. So the benefit from the cheaper debt will be offset. Initially, if you apply to a bank, it will charge you, let's suppose, 10%. Without repaying this 10% or return this 10%, you again go to the bank and borrow another amount of money, it will obviously charge you bet high because now your risk profile is high. So the this lower rate is offset by this benefit will be offset by this 12%. Hence will push up the cost of capital upward. Cost of debt remain constant up to certain level and then rise with the demand for the debt, because bank will charge high if people start demanding borrowing from these bank. And risk profile of the firm also increases, means risk the high the debt, the high the risk profile of the company. So cost of debt will not remain the same. Cost of equity remain constant or increase slowly up to a certain level. Cost of equity may remain the constant, but it will also increase after certain level. When the company risk profile increases, their shareholder will expect high from the company. Overall cost of capital weak, decline and then start increasing. This is basically then that we can gauge an optimal level of weighted average cost of capital. Let me explain here. It initially when we are borrowing, the company charge less on the debt, and we are going to borrow or we increase our borrowing, the company again charging less, but at certain level the cost on the debt start increasing because of the demand for borrowing from different companies and from the risk profile of the company. So when the risk increases, the bank will demand a bit higher interest rate on their borrowing. So first of all, equity may remain the constant, but after a certain level the cost of equity will be increases with the risk profile due to lower rate on the debt. Overall cost of weighted average cost of capital will be decreases because cost of equity is remain constant while cost of debt is decreasing. So at certain level it will remain the lowest point, and then when the cost of equity and cost of debt start increases, weighted average cost of capital will also be increasing. So this lowest one degree of leverage is optimal point where we have low WACC, low weighted average cost of capital. So we evaluate our companies on the basis of weighted average cost of capital, so it will increase our value of the firm. What are limitations of these approaches? Perfect capital market assumption is not valid, as we discussed at the start. Taxes exist in every economy in modern society. Cost of debt changes. Why it changes? With monetary policy of the country, demand for debt, risk profile of the company. These are the three factors which cause to increase cost of capital. 100% dividend is almost impossible. This is all about today's lecture. Thank you.